Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this video, we will try to understand where we have the highest probabilities for a potential move on this pair. And the way in which we will be doing that is first, analyzing the pair from a technical perspective. Then we will go and see what we have when it comes to the commitment of traders, which is what hedge funds and the non-commercials, so the biggest speculators in the market, are doing. So without wasting any more time, let's go straight to the charts. In today's video, I want to speak about US oil because we do have very interesting price action and structure at the moment. So without further ado, let's get straight into it. Starting here on the monthly, what we can see is that the market has just created this candle here. Now, when you have a candle like this with a very long wick and a green body, what you usually expect is for the next candles to fill in the wick. And in fact, so far, that is exactly what the market has been doing. The two following monthly candles started to fill in the wick. Now, why is that? Why do we expect the wick to be filled? Because usually when you see a candle like this on the monthly, it usually indicates that on lower time frames, so for example on the weekly time frame, you will actually have an impulse and a correction, in which the correction is exactly the wick that we see here on the monthly time frame. And what we know is that after an impulse and a correction, what we expect is for the market to create the continuation to the upside, completing the impulse, correction, and impulse pattern to the upside. So from a monthly perspective, everything seems pretty bullish and we could expect more potential continuation to the upside. Dropping down on the weekly, what do we see? Now here on the weekly, we can see how at the moment we are testing quite strong previous weekly resistance, which was resistance here. The market then broke it to the upside. At that point, this previous resistance was turned support here, and again here. Now what we can see is that at the moment we are testing that zone and we are rejecting it to the upside. So in a situation like this, what we can expect is more potential continuation. We can also notice how in general, after an impulse, if you want to measure the correction, what you have to do is take the Fibonacci from the low to the high of the impulse. And if we do that, we can see how the market created a perfect 0.786 Fibonacci retracement, testing also previous resistance turn support. In fact, these two levels were lining up exactly at the same zone. The market tested it, and at the moment we could expect more continuation. Dropping down on the daily, what do we see? Now, from a daily perspective, I spoke about US oil after this impulse. I explained all the reasons for which we could expect a potential correction and then continuation to the upside. And in fact, that is exactly what the market has just given us. And by the way, I will link in description this previous analysis so you can go and check it out for more free education. However, what we can see is that now that the market has created that move, we have created and broken to the upside new structure. In fact, we can see that in creating this continuation to the upside, the market first found resistance at this level. We have now broken above this level. So this previous resistance is now turned support here. And what we could expect is for the market to go for a retest of this previous resistance turned support and then potentially to reject the zone to the upside. Now, if we go and see what we have when it comes to the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market, are doing, and we check the data for the CAD, which usually correlates quite well, what we can see is that net positions lately have been decreased. In fact, we went from having 21.2k net positions all the way down to having 9k net positions, with 7.3k shorts added with the last report and 4k longs getting closed. So clearly we are seeing this decrease of net positioning after we had all this increase. So first we got increased, now we're getting decreased. Now in a situation like this, we could expect a potential correction to this zone. This is the next area inside of which we could get an accumulation and a rejection to the upside, basically a zone inside of which we could be finding quite strong buying pressure. So we do expect a retest of this level. So if the market will actually successfully manage to test this zone, how we could be approaching it for a potential rejection to the upside. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily, combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. So what we could be doing is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we would have to an intraday bullish market. And if the market would shift from an intraday bearish to bullish market and provide to us one of our valid entries, at that point we could be looking for this potential move to the upside for the completion of this impulse correction and impulse pattern to the upside. Now, if you don't know what I'm speaking about when I say market environment shift and valid entries, that is all part of the mentorship program, which you can now access completely for free. In fact, the link is in the description, and I really suggest that you go and check it out because you can learn all the rules of the strategies and you will find a lot of valuable content inside of it. Now, if you enjoyed this video, also make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.